If you want to understand how to organize your finances properly, save money effectively, and build wealth step by step, this video is for you. We'll go through all the fundamentals you need to be financially stable, from setting realistic goals to the right account structure and investing in ETFs. You'll learn everything you need to create a long-term, reliable financial system. Chapter 1. Why clear financial goals matter. The first step toward healthy finances doesn't start with numbers. It starts with goals. Before you think about accounts, interest rates, or ETFs, you should know what you're actually saving for. Set specific financial goals, short-term, medium-term, and long-term. A short-term goal might be a vacation you'd like to take in 6 months. A medium-term goal could be buying a car or furnishing your home. Long-term goals might include retirement or financial independence. Write down how much money you need for each goal, and by when you want to reach it. This helps you calculate how much to save each month and shows whether your goal is realistic. When you know why you're saving, it's much easier to stay motivated and consistent. Chapter 2. Get an overview of your finances. Before you can improve anything, you need to know where you currently stand. Start by making a simple inventory. List all your assets: your checking account, savings account, old insurance policies, or investment accounts. Then list all your debts: credit card balances, loans, or other obligations. Subtract your debts from your assets to find your net worth. It sounds simple, but this step is crucial. Seeing your full financial picture helps you plan what to do next. Chapter 3. Pay off debt before building wealth. If you have debt, repayment is your top priority. There's no point in investing while you're still paying high interest on loans. Every euro or dollar you repay gives you a guaranteed return, because you no longer pay interest on it. Especially with consumer loans or credit card debt, interest rates are usually higher than what you'd earn through investing. So remember, become debt-free first, then focus on building wealth. Chapter 4. The emergency fund, your financial safety net. Once you're out of debt, the next step is an emergency fund. It protects you from falling back into debt when unexpected expenses occur, like car repairs or job changes. As a rule of thumb, your emergency fund should cover 3 months of living expenses and be easily accessible. Keep it in a separate savings or money market account where it's safe and available when you need it. Chapter 5. Income, expenses, and your savings rate. To build wealth long-term, you need to know how much you can actually save. The best way to find out is by tracking your spending. Use an app, a spreadsheet, or just paper to record your income and expenses for a few months. You'll quickly see where your money goes and where you can cut back. As a rule of thumb, aim to save at least 10% of your net income. Ideally, work your way up to 20 to 30%. If that's too high right now, start smaller and increase your savings rate each time you get a raise. For example, by saving half of any pay increase. That way, your savings grow automatically without feeling like a sacrifice. Chapter 6. The right account structure. Many people try to save what's left at the end of the month, and then realize there's nothing left. That's because saving doesn't work when it depends on willpower. It works when it's automated. The simplest structure looks like this: a checking account for your income and everyday spending, a savings account for your emergency fund, an investment account for long-term investing. As soon as your paycheck arrives, set up a standing order that automatically transfers a fixed amount to your savings or investment account. This way, you save first and spend what's left, not the other way around. Chapter 7. Why investing is essential. Saving alone isn't enough. Money sitting in a bank account loses value over time due to inflation. As prices rise, the same amount of money buys fewer goods and services. To protect and grow your purchasing power, you need investments that outperform inflation. For example, 10,000 euros sitting in cash lose almost half their value in 30 years with 2% inflation. But if you invest that same amount in stocks or ETFs earning about 7% per year, it could grow to over 70,000 euros. In other words, not investing is often the bigger risk. Chapter 8. The main asset classes. There are many ways to invest, but the most important asset classes are: 1. Stocks, ownership in companies that can pay dividends and rise in value. 2. Bonds, loans to governments or corporations that pay interest. 3. Real estate, property you own or invest in through funds or REITs. 4. Commodities, such as gold or oil, mainly used for diversification. 5. Alternative assets, including cryptocurrencies or collectibles, which tend to be high risk. For most private investors, stocks through ETFs will form the foundation of long-term wealth building. Chapter 9. Risk and diversification. On the stock market, the rule is simple. Higher returns come with higher risk, but you can reduce that risk through diversification, spreading your money across many companies, industries, and regions. This way, the failure of one company doesn't heavily impact your portfolio. ETFs make diversification easy by investing in hundreds or even thousands of companies at once. Chapter 10. Understanding ETFs. An ETF, or exchange-traded fund, tracks an index like the DAX or MSCI World. By investing in an ETF, you automatically own shares in all the companies within that index. ETFs are low cost because they're passively managed, transparent because you know exactly what's inside, liquid as they trade on stock exchanges, and safe since your money is held as segregated assets. ETF savings plans are especially useful. You invest a fixed amount each month automatically, benefiting from the cost average effect, buying shares at various prices, and averaging your cost over time. Chapter 11. Adjusting risk through allocation. Not everyone is comfortable with 100% in stocks, and that's perfectly fine. You can reduce volatility by mixing asset classes. For example, 80% stock ETFs, 20% bonds or savings. This mix is called your asset allocation. The more stocks you hold, the higher your potential returns, but also the greater the ups and downs. As you get older or build more wealth, you can gradually lower your stock portion. Chapter 12. Time is your greatest ally. The market goes up and down. That's normal. In the short term, returns fluctuate. Over the long term, the trend is clearly upward. The key rule is time beats timing. No one can predict the perfect entry point, so regular investing and patience matter more than market timing. Even major crises, financial crashes, pandemics, or recessions have all been followed by recoveries. Those who stay invested are the ones who benefit. Chapter 13. Getting started in practice. Once you're ready, open an investment account with a trusted broker. Deposit your starting amount or set up a monthly ETF savings plan. Even 50 or 100 euros is enough. Popular global ETFs include the Vanguard FTSE All World, or MSCI ACWI, which hold thousands of stocks from both developed and emerging markets. With one simple product, you're diversified across the world and can let your investments work for you. Chapter 14. 3 final tips. 1. Start small, but start. Even if you can only invest 25 euros per month, consistency matters more than size. 2. Check your portfolio rarely. Constantly monitoring it can make you emotional. Investing is a marathon, not a sprint. 3. Stay calm during crises. Market crashes happen. They've always recovered. Patience pays off. By following these steps, you'll have built a solid foundation for your finances, with clear goals, structure, security, and a plan for long-term growth. Financial success isn't about luck or timing. It's about having a system and sticking to it. I hope the video was helpful. If so, please give us a thumbs up. I would appreciate it if you would subscribe to our site so you regularly receive new videos and tutorials on investing, investment strategies, and financial products, and the world of finance becomes more understandable for you. Thanks for watching. See you in the next video.